For 50 years, Warren Buffett gave us one rule: buy and hold. He told us to never bet against America. Time in the market beats timing the market. But over the last 18 months, the Oracle of Omaha has been breaking his own commandment. While everyone was chasing the 2025 rally, Buffett was selling. He slashed his Apple stake, he dumped Bank of America, he has now amassed $325 billion in cash, larger than the GDP of entire countries. If the man who invented buy and hold has stopped buying, what does he see coming in 2026 that we don't? Is the strategy dead? Or is he preparing for the sale of the century? Let me show you the scale of what just happened. Apple. Buffett called it Berkshire's fourth business. He loved Apple more than See's candies. He said it was the best business in the world. And he cut his stake by more than 50%, from over 900 million shares to less than 400 million. He sold more than half of what he called the best business in the world. But that's just the beginning. $325 billion in cash? Warren Buffett now holds more treasury bills than the Federal Reserve held during the financial crisis. This isn't money on the sidelines. This is a defensive fortress. And the silence. Buffett hasn't made a major acquisition since 2015. 10 years. Why? Is everything just too expensive? Here's the answer. Buffett isn't sitting on cash because he likes it. He's sitting on cash because he hates the price of everything else. The man who built an empire buying great businesses at fair prices cannot find anything fairly priced. So he stopped playing. Let me show you why buy and hold just died for right now. Buffett says the market has become a casino, and buy and hold only works when you're buying at reasonable prices. But in late 2025, prices are insane. The Buffett Indicator measures total stock market value divided by GDP. Right now, we're at 200%. The only other times we hit this were March 2000 before the dot-com crash and September 2021 before the correction. 200% means stocks are worth twice what the economy actually produces. That's not investing, that's speculation. When valuations are this high, future returns must be lower. If you buy stocks at twice what they're worth, you need them to triple just to get a 50% gain. Buffett has done the math and decided he'd rather sit out. And treasury bills now pay 4 to 5% risk-free. Why risk losing 20% in overvalued stocks when you can earn 5% guaranteed? He won't, and neither should you. The weird death of buy and hold is actually the rebirth of risk management. Buffett isn't afraid of missing out. He's afraid of losing. So what's the new playbook? He calls it strategic patience, the sniper approach. Ted Williams knew you don't have to swing at every pitch. You wait for the perfect pitch down the middle, then you swing with everything. The new strategy isn't don't invest. It's wait for the fat pitch. Buffett is sitting on $325 billion, not because he's scared, but because he's waiting. Overvalued markets eventually correct. They always do. And when they do, he wants to be the only one with cash. Everyone says cash is trash. Inflation eats it. But in a high valuation world, cash is an option on future assets. Cash lets you buy businesses at 30 cents on the dollar when everyone else is forced to sell. Cash is power. In 2008, Buffett had cash. Goldman Sachs came begging. General Electric came begging. He got deals nobody else could get because he was the only one with money. In March 2020, same story. And he's setting up for 2026. Buffett is positioned for maximum flexibility, not maximum growth. He's not trying to win this year. He's trying to win the next decade. So, how do you apply this? First, don't panic sell. You're not Warren Buffett. You have bills and retirement. Don't sell everything, but stop blindly buying overvalued indexes. Maybe pause. Maybe be selective. Second, build your own war chest. Increase cash reserves, high-yield savings accounts, money market funds, treasury bills. Your goal is dry powder when the sale starts, and it will start. Markets correct. The question is whether you have cash to deploy. Third, review your winners. What's up 50%, 100%, 500%? If you own something insanely overvalued, take a page from Buffett and trim it. Taking profits after huge gains isn't market timing, it's risk management. Fourth, change your mindset. Stop thinking time in the market. Start thinking value in the market. Buffett is proving that when prices are too high, patience is better. You can wait. You can be selective. You can build cash. The buy and hold era will return. When valuations reset, when fear replaces greed, that's when it works again. But right now, the smartest investor in history has decided to fold. In 1999, everyone said Buffett was washed up because he wouldn't buy tech stocks. He sat on cash. He looked foolish. Then the bubble burst. The Nasdaq dropped 80%. Buffett looked like a genius. He had cash. He bought businesses for pennies. In 2025, people whisper again. They say he missed the AI rally. They say he's too conservative. But the death of buy and hold isn't permanent. It's a warning. The greatest investor in history has looked at his hand and decided to fold. He's taking his chips off the table. Because when the game resets in 2026, he wants to be the only one left with money to play. When the sale of the century starts, when stocks drop 30, 40, 50%, when the best businesses trade for half their worth, will you have the cash to buy? Or will you be broke, fully invested, watching from the sidelines while Buffett makes another fortune? The choice is yours. But the clock is ticking.